Joining us right now, former U.S. Senator and Banking Committee ranking member Pat Toomey. It's great to see you, Senator. Want to talk about SVB. We are watching the markets, we should say, in a true sell-off mode, in large part now on the back of concerns about European banks, including Credit Suisse. Credit Suisse, by the way, off close to something like over 20%, I believe, right now. And that has people nervous. But I'm curious on SVB and how you think about the regional banks here in the United States, and whether you think more dominoes fall, or given what the Treasury and the Federal Reserve have said about trying to protect depositors, that we're in the clear.
Well, there's no question that they've taken a very, very dramatic step here. So I think the risk is much reduced. But Andrew, I think the really important lesson that we have to internalize from this whole episode is just how dangerous it is to have extremely imprudent monetary policy. I think that's the source of this problem, right? Think about it this way. First, we had wildly excessive spending, and at the same time, long after the financial system was clearly no longer in peril, the Fed was still maintaining unbelievably easy money, buying bonds, super low interest rates. That contributed a lot to the surge in deposits that wound up on the balance sheets of banks like SVB. Then, at the same time, the Fed was keeping interest rates at zero, nominal rates, real rates were negative. And so banks inevitably were forced out the risk curve, not the credit risk curve, but the maturity risk curve in this case, because the curve was still positive in its shape at the time. And then finally, when the Fed realized how badly behind the curve they were and they suddenly raised rates, they created the bond portfolios that they had helped to create in the first place.
So, Senator, let me take the other side of this for the purpose of this debate, which is to say, you know, it's become very popular to blame the Federal Reserve for all of these problems that we're having. But isn't there some level of personal responsibility? You've talked about personal responsibility.
Sure.
Personal responsibility on behalf of the executives managing these banks to make the right decisions. Don't they need to say, oh, it could rain tomorrow, it could rain, we should have some umbrellas available if that day were to come? And by the way, unlike the weather oftentimes, Jay Powell actually told you it was going to rain tomorrow. He told you exactly what was going to happen.
Yeah. So first of all, Andrew, I'm not arguing that there's no responsibility on the part of management. Surely there is. Evidently, it didn't occur to them that one day $40 billion of deposits might just walk out the door in 24 hours. That's a pretty unusual occurrence. It didn't occur to them. In hindsight, it should have. But what I'm saying is the Fed created the dynamic where all of these things start to come together. And that's a huge problem. By the way, there's another element of this, right? And that is the regulatory regime contributed to this problem. And I mean in the following sense, right? There's an inherent instability in a fractional reserve banking system. That's part of the nature of a system where you transform maturity between the deposits you take and the loans you put out. We've long completely guaranteed small and under $250,000 deposits. So those depositors have nothing to be concerned about. And then if you put large deposits with the SIFIs, with the giant banks, that's implicitly guaranteed by the government. That's been pretty clear. And so the category in between, mid-sized banks that have a significant volume of uninsured deposits, that's the only place where the risk remains in the system. Well, and so when things start to look like they're going sideways, there's a big risk of a flight